This is a bearish put spread on IBM. IBM is trading roughly around $165, $164, and you wish to profit on a bet that IBM moves lower. So you could short the stock, but if you want to do it in a limited risk, you would buy a put option. The problem with buying put options is you're spending money to buy the premium. So spread plays sell one option to pay for the purchase of another. So with puts, you buy the high strike and you sell a lower strike. With calls, if you're trying to profit on a stock moving higher with calls, you would buy the low call and sell the higher call. So they're symmetrical. And the whole idea is just to lower your net investment cost. The issue, though, is, of course, you give up something for doing that. In this case, looking at IBM, trading 164, and we're going to buy the 165 strike, and we're going to sell a strike against it. So we're going to sell a lower put, the 160s. So the range of profit for you is only this $5 range. And you're going to make money up until the stock falls through 160. But after that, it could fall to 130, it could fall to 100, it could go to zero, and you will not make $1 more. So your profit range is a $5 downside bet on IBM. And you pay for that. And so let's take a look. Buying the 165s, if we were doing this for 10 contracts, well, $4 per share, 10 contracts of 100 shares each, 1,000 shares. So that's $4,000 out of pocket. And you're only trying to make, money on IBM moving down, and you kind of think it's only going to move down a little bit. So you sell a lower strike, the 160s, for 190, 1,000 shares, so $1,900. Cuts your cost of the trade in half, but again, you give up any movement below 160. So let's take a look and see how all this works out. The 10 contracts, 1,000 shares, money out of pocket, $4,000, $4, 165 strikes that you own. You sell to pay for that, the 160 strikes for 190, $1,900 out. So your net investment, $210 per share or $2,100. Now let's say that IBM moves to 162. So you have a put at 165 and things move below it, that's profitable. You have another put at 160 and the position did not move below the 160. So that one, not profitable. It's just going to have a zero value. And we can see this by looking at the two formulas. The long put, it's the max of 0, and strike 165 minus 162. $3 profit times 1,000, 3,000 profit. The short put, it's going to be the opposite of whatever the long does. So the negative sign goes in front of everything. It's going to be 162 minus 160. Well, that's a negative. So the max of 0 or negative is just 0. Negative sign in front of 0, still 0. Doesn't matter if you multiply by 1,000 shares, still 0. So looking down at our payoffs, we evaluate the long put, the short put at 162. We have 3,000 profit on the long, no payoff on the short, no loss also on the short. That's good. And so 3,000 total profit, $2,100 cost is $900 in profit at the end. The other way to reach it would be 1,000 shares times the $3 profit minus the $2.10 cost to set up that spread. And either way, $900 at the end. Very limited range of payoff. And the best benefit is it lowers the cost of investing, and it's a limited risk trade. And that's a bearish put spread.